Guys, today I'm going to be going over some stock terminology for beginners. It's going to be everything you need to know to start out as a beginner. I'm going to try and break it down really simple for beginners looking to get into the stock market. If you're new to the stock market or investing in the stock market, you definitely want to stick around. You're going to learn some key things that you definitely want to know before investing into the stock market. So the first term is going to be most simple and probably the most important that you want to know is a stock or share. So a share or stock basically means that you own a very small piece of a company. So if you buy a share of Facebook, you'd own a very small portion of the Facebook company. So essentially when you buy a stock, you're taking equity of the company. You're like buying a small piece of it. You're technically a very small owner of a company. So how do you actually get a share? You buy it. So buying just means to take position in a company or buy shares of a company. So becoming a very small owner or a shareholder in a company. So what's the opposite of buying? Selling. So once you've bought a share or a stock and you want to sell it for whatever reason, whether you want to take your profits or the stock's going down and you don't want to lose any more money and you want to sell and get out, then it's just basically getting rid of either some or all of your equity in the company. So let's say you have 10 shares and you sold five of them, then you're just basically getting rid of half of your position in that company. Next up is exchange or stock exchange. A stock exchange is basically a place where stocks or publicly listed companies are traded, so bought and sold. So, for example, the most common one that you've probably heard of is the New York Stock Exchange. If you're from Canada, there's the Toronto Stock Exchange, which is basically the Canadian version of the New York Stock Exchange. There's also the NASDAQ, NASDAQ, which is another big stock exchange in America. So it's just basically where stocks are listed. So a ticker symbol or a stock symbol is basically how you find the stock on the exchanges. So if you're trying to find Apple, it would be on the NASDAQ stock exchange, and it wouldn't just be you could look up Apple and it would come up, but another way of like shortening it is just looking at the stock symbol. So when you're actually buying the stock, you would look up AAPL, which is the stock symbol. So it's just basically a short form of the company. Like TD's stock symbol is TD, or there's every company or every stock has a stock symbol. It's just basically a easier way to find it and a short form of the company. So a dividend. So it is a portion of a company's earnings that are paid to shareholders. Once you own the stock, you don't have to sell it to get paid the dividend. For example, if you buy one share of a company for $100 and they pay a quarterly dividend for every 3 months, and they have a dividend yield of 4%, you would get $1 paid to you every 3 months. As long as the company keeps the dividend and you hold the stock, you'll get paid that dollar every 3 months. So you put $100 in, you get 4% of that returned annually, which would be $4 returned annually, and they pay a quarterly dividend. So they pay a dividend every 3 months. So $1 in January, $1 in April, and yeah, whatever it would work out to, but you'd get $1 every 3 months, so $4 annually. If you invested $1,000, then you'd get $40 back. So $10 in January, $40 or $10 in April, and you get $40 returned throughout the year. So as long as the company keeps that dividend yield the same, they could increase it, they could stop it completely, they could lower it. But as long as they have a dividend yield and you hold the company, you're going to get paid this dividend no matter what happens. So, market in the green or market in the red, or a stock in the green or a stock in the red. You might hear this a lot, people just saying, like, oh, my stock's in the green today. Oh, my portfolio, which is your group of stocks, is in the red today. It went down. Red means the price has gone up in a stock, your portfolio, or a market. Green means the stock or the price has gone up for your portfolio, like your collection of stocks. Or let's say Apple went up 2% today. They're in the green. Apple went down 2% today. They're in the red. It just basically is an easy way to see if the price was going up or down. So a portfolio or a stock portfolio, it's basically just all of the stocks that you have equity or shares in. So you bought, let's say, 4 stocks: Apple, Facebook, Snapchat, and Tesla, for example. You bought those 4 stocks. Those 4 stocks will be the ones in your portfolio. It's just basically all your stocks that you have invested in or have currently equity in. So if all 4 stocks that you bought went up, then your portfolio would be in the green. If they went down, your portfolio would be in the red. So it's just basically your collection of your stocks. So a bear market, you're going to hear this term from people if you keep on researching the stock market or watching YouTube videos on it. You're going to hear this term thrown out there a lot. So a bear market just basically means when the market has a prolonged price decline. So over a long period of time, let's say the S&P 500, which is an index fund. I'll get into more of that later, but let's say just this whole stock market was down 3% over the last 8 months. It would be considered a bear market. So a bear market is just when the stock is kind of staying steady or dropping a little over time, and it's not really moving upwards at all. That's considered a bear market. And what is the opposite of that, you may ask? Well, it is actually a bull market. A bull market is a prolonged period of time where the stock market has been experiencing price growth. So an example would be if the stock market was up 21% in the last 18 months, that 18 months would be considered like a bull market. So yeah, you're going to hear the bull market and bear market terms thrown out there a lot. Just remember, a bull is up. So like a bull charges up when it fights, let's say, and a bear kind of goes down on its predator. So that's how I remember it. A bull like jumps up, a bear goes down. That's just a stupid way that I remember it personally, but they're pretty easy terms. You'll get the hang of it. So market cap or market capitalization. You'll see this if you're going on like Yahoo Finance or looking at any website that has stock statistics on it. You'll see this as one of the things that it lists for a stock. So every stock has their own market capitalization. It's basically the total market value of a company's outstanding shares. So to get the market capitalization or market cap, you multiply the total number of shares by the current price of one share, and you'll get the market cap. So let's say there are 1 million shares of a company, and each share is $100. The market cap would be $100 million. So you just basically times the number of shares that are being publicly traded. It would be more than 1 million for like every company, but that's not the point. It's just kind of as a guide, but yeah, you get the hang of it. You multiply the number of total shares by the share of one, or the price of one share, and that's how you get the market cap. Now I'm going to get into some kind of other things that you can invest in the stock market. Like these are just still stocks, but it's a way like, you can invest in real estate in the stock market, and this is a way of doing that. It's called a REIT, or Real Estate Investment Trust. And it basically enables you to invest in real estate without having the duties of a landlord or having a mortgage or any of that kind of other stuff. All you have to do is buy the stock, and you kind of are invested in the real estate market while just being in the stock market. So it is kind of nice. So yeah, you definitely want to look into real estate investment trusts if you are going to be looking at the stock market. If you're from Canada, I like RioCan and Smart Centers. Those are the two I hold in my portfolio. But if you're from the US, just look up US REITs, do lots of research on them, and pick some that you like. But this is a great way to invest in real estate while being in the stock market. An index fund or an ETF, this is going to be the first thing an advisor tells you to invest in probably if you go to them in the stock market. It's a pretty safe investment. It is basically just buying the market, essentially. So you're buying a basket of stocks in one asset. So an index fund or ETF is essentially you own like hundreds of companies, very, 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 very small shares of those companies. But for an example, the most popular one is the S&P 500. If you bought a share of the S&P 500, you'd have a slice or you'd own equity in each of the 500 companies in the S&P 500 just by buying one stock. So the S&P 500 is the most popular one. It covers the top 500 traded companies in America, and it is by far the most popular index fund. And yeah, so index funds are a great way to buy the market. They have an average return rate per year of about 12%, which is great, and most of them pay like dividends as well. So they're not going to be very high dividends, most of them, but they'll pay dividends, and the growth on them is historically been really good. So there's something that you definitely want to look into as an investor. So like I just said, the S&P 500, it's the most popular index fund or ETF, and it's just basically covering the top 500 publicly traded companies in the USA. So it's used as an overall indicator on how the market's doing as a whole. So if people say the market is doing well or is in the green, it generally means that S&P 500 has gone up that day. They could also be talking about the Dow Jones, which is basically the top 30 stocks. I usually look at the S&P 500 because 30 stocks, although they're the biggest 30 stocks, doesn't give you a great idea of how the whole market's doing. Neither is the S&P 500, mind you, but at least gives you 500 of the biggest companies. So it kind of tells you a much better idea than the other one. But the S&P 500 just basically is an overall indicator on how the market is doing as a whole. So volatility, or like a stock's volatility. So it's the expected price fluctuation in the market. Having a high volatility means the stock moves more and is a higher risk. Having a low volatility means it is like a safer stock or investment, but it will not move as drastically. So it's not going to go up like double overnight kind of thing, like Bitcoin could, right? It's just kind of going to slowly go up over time. But more volatile stock is could go up and down like daily, like it could double overnight or be divided in two overnight, just like that. So the more volatile, the more risk. So the S&P 500, for example, is going to be way less volatile and much more of a safer play than Dogecoin or Bitcoin or something like that. But it doesn't mean one is better than the other. It just means that the more volatile the stock or asset is, the more risk it has. So a stock split. This won't happen very often with stocks, but you might hear the term once in a while. So when it does happen, let's say you own Apple or TD Bank or whatever stock, it doesn't really matter. So it basically just divides the current share price, usually in half, and then doubles the number of outstanding shares. So for example, let's say a company had 1,000,000 shares and its stock price was $100 and the stock split. There would now be 2,000,000 shares and the stock price would be $50. So it's the exact same thing. Like the companies just do this to make the stock look cheaper so more people can buy it. But when a stock splits, the value of the stock doesn't change at all. Like you're, as a shareholder, you now have 20 stocks at $50 as opposed to 10 stocks at $100. You still have the same amount into the company. So nothing happens to the value of a stock when a stock splits, or your equity just has more shares, but the value is the exact same. So a blue chip stock. So a blue chip stock is a major company with a great reputation. They're a large, well-established company, and they kind of have a low risk because they usually have a great reputation with great earnings and great dividend growth and stuff like that. So an example of that would be like Johnson & Johnson, the healthcare company. That's an example of a blue chip stock. But any like company with a great reputation, with great earnings over the last like 30, 40 years, over a long period of time, well established, and these stocks are a low risk. So a growth stock is a stock that you kind of buy, not really looking at the dividend too much, but more looking at you want the price to you think the price is going to go up. So like this chart, you think it's going to grow pretty rapidly, exponentially, if you will, and you're gonna maybe want to sell it. Maybe this won't be a long-term hold, maybe it will, but you're not really looking to have too much passive income off of this type of stock, like a dividend stock. You would be looking for more passive income, but you're kind of just buying. Let's see, bought it at $50. You're kind of hoping it goes up to 100 pretty quickly. It's a growth stock, and you believe the company is going to grow a lot, and you invested in it because you're hoping it grows. This is the last one. Don't worry, guys. I know you're probably falling asleep, but if you're still watching, that means that you have an interest in this and you want to learn, which is better than 99% of people. So congrats to you. You probably are going to be successful if you made it this far in the video because it shows that you're willing to learn. But anyway, a dividend stock is a stock that pays a stable dividend yield, and if you buy this type of stock, you usually are planning on holding it for the long term. So, like I was saying earlier about dividends, go back to that part of the video. It's one of the first terms I did cover. But a dividend is just basically they pay it to you over time. So every 3 months or so, let's say, and you kind of buy the stock, just collecting that dividend over and over and over again. The dividend can grow over time, with which most like blue chip stock companies, it will grow over time, the dividend. And it's just a stock that you kind of want some passive income. That's why you're holding it. So it's a great stock. It is my personal favorite type of stock. I love having passive income, just getting a payday every 3 months from a different company. It's the best feeling in the world, trust me. But anyway, that's a dividend stock. Thank you guys for watching this video. Subscribe if you want to learn more about the stock market. I'm trying to post at least twice to 3 times a week right now. And peace out, guys.